Hey there, everyone, and welcome to the Final Bar. It's Monday, July 15th, and I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a sunny and warm Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis and the power of the Stockcharts platform. The S&P, the major averages, continuing to push the long side. The S&P up about 0.3% today. Even more strength in small caps. The IWM continues to outperform here in July, up another 1.4%. Two sectors at the top of the list, energy and financials. Two sectors we've not seen at the top of the list too often recently. So with that in mind, let's get right to our market recap and look at how things have played out in today's market action. The S&P 500, as I mentioned, up 0.3% today, closing just about 5631 for the first time. Now, that's what's interesting is if you look at the little two-day preview chart, there's Friday's action. You can see the sell-off into the close. Here's today. You can see the last half hour. We actually bounced down and retested yesterday's close before brief buying in the last 10-15 minutes. So, overall, we're seeing some weakness in the last hour of trading here, which usually indicates that institutions are starting to unwind positions or at least be more on the sell side versus the buying side. But we'll see. Overall, we're continuing to make headway to the upside. The mid-cap and small-cap index is also to the upside. The S&P 600 small-cap index up 1.4%, handily outperforming the small cap index and the Nasdaq 100. The VIX overall moving slightly higher, still in the low teens. So we have low volatility, which means low fear or low uncertainty, which overall continues to say bull market conditions for stocks. Interest rates overall move slightly higher today. This is after the Fed's or the latest inflation data, that is at the end of last week, coming in way lower than I think a lot of people have expected, suggesting that the Fed may be closer to their first rate cut. Powell made comments, that's the Fed Chair Jerome Powell made comments earlier today implying, or I guess hinting that a first rate cut may be coming very, very soon, maybe as early as this next Fed meeting. Overall, interest rates moving slightly higher through the course of today's action. The 10-year yield around 4.23. The long bond yield still around 4.45. The dollar index, no real change from Friday's close, and bond prices overall moved slightly lower. Looking at the commodity space, you can see the broad DBC commodity ETF was down about 0.7%. A lot of that came with from weakness in the energy components within the commodity space. Natural gas prices in particular were a lot lower. The UNG, which is a natural gas ETF, was down over 6%. The USO, which is a crude oil ETF, just down slightly from Friday's close. Copper prices, silver prices lower. Gold, the GLD, actually managed to finish about 1/3% higher from Friday's close. Bitcoin overall was in the upper 50K range over the weekend. Going into today's equity trading hours here in the U.S., just pushing above 60K, and at this point, we're almost to 64,000. So you're seeing a bit of a short-term nice recovery after some weakness over the weekend. Bitcoin and Ethereum both up about 5 to 6% as we're recording today's show. Looking at the 11 S&P sectors, you can see energy and financials clearly the winners today. The XLE, the energy sector, up 1.5%. Some of those leading names like Diamondback and others have had pretty nice recoveries after short-term weakness over the last quarter. The financial sector, number 2, up 1.4%. Industrials, number 3, up 1.7%. So these are very value-oriented sectors at the top of the list. At the bottom, you have utilities down 2.4%. Pretty defensive sector. Consumer staples, another fairly defensive sector, down about 0.6%. Healthcare, down about 1/3% from Friday's close. As of Friday, you can see that the market trend model, which I created and have used for quite some time, overall bullish on all time frames. And my main model uses the S&P 500's data using a series of weekly exponential moving averages. We update that formally after the close every Friday. And as of last Friday, the July 12th, medium term, short term, and certainly the long term, all remaining very much positive. Looking at the what we call the Magnificent Seven and Friends, some leading growth names, you can see Tesla and Apple both having pretty decent updates, both up over 1.6%. Netflix was up about 1.4%. Amazon down actually 0.9%, along with Nvidia and Meta. So, it's not a big update driven by big growth stocks. I don't want to say that those days are behind us because I can't guarantee that, but certainly starting to feel like that, right? When Amazon and Nvidia and Meta are down and the financial and energy sectors are up, boy, this is a different look than we've experienced in quite some time. My sort of contrarian hat, my contrarian thinking tells me that this is part of a natural leadership rotation. Growth has been dominating certainly in the first half of the year. Now that we're getting into the second half of the year and getting into Q3, the earnings season here for Q2, over the next couple of weeks, certainly suggests that we may be rotating away from growth leadership into value leadership. The real concern would be if we rotate into defensive sectors like utilities and real estate. A day like today tells you that's really not necessarily the case just yet. Let's go to a daily chart of the S&P 500 and see how things played out through the course of the day. You can see this sort of slow and steady uptrend remains in play. Today, we do not have a new all-time closing high, but we did get an intraday high, trading above 56.50 only for the second time. Friday was the first time we got above that. Level. When I think about the daily chart of the S&P 500, at times it's been very busy with a lot of lines and a lot of what I call lines in the sand, levels of potential support. When the market's in a consistent uptrend like this, I think you just follow the trend as long as possible, right? It's not about, in my opinion, investing is not being about being right all the time or even most of the time. You can be wrong even more than you're right. But when you're right, you want to stay right. And when you're wrong, you want to admit that quickly and reverse it, right? So let your winners run and cut your losses as quickly as you can. It's a good way to survive as an investor and indeed thrive. So when the S&P is giving you these sort of slow and steady gains, when the Nasdaq has continued to compound its returns from the first half of the year and continue to make new all-time highs, this is not the time when I would tend to be selling the S&P 500. I'm going to hold this as long as it continues to get it done. Now, the question, and I think the real issue is, what does it mean, right? What would be that level or that signal that would tell you, okay, the S&P is no longer getting it done. I need to start to maybe change my positioning or change my perspective. So I think having a line in the sand is important. For me, a trend line using the major lows over the last 12 months, I think is serving me pretty well so far. That's taking the October 23 low, the April 24 lows, the May 24 lows. All of that is collected or indicated with this pink trend line. So as long as we remain above this pink trend line, conditions are pretty good, which means as of today, right over the next week, if we would sell off, we remain above 5,500 or so, this uptrend is still in place. And we're going to have higher lows if that uptrend continues. So just look to see if the lows keep making progress. I think another real important level to pay attention to would be 5,400. That was that major price gap in early June. 50-day moving average is right around that level as well. So I think holding that might be important to many as well. But from a long-term perspective, I mean, right down to 49.50. That's the April swing low. That's the 200-day moving average. I mean, market can go all the way down to there, which is what, another 700 points below current levels, almost 800 points. So there's a lot of room for this market to go down and still be within a long-term uptrend. It's how much of a short-term sort of tactical pain that you are comfortable with before you want to sort of unwind and either play potential downside or be cushioned from potential downside. So I would say, given the extended nature of this market, giving the potential of a leadership rotation and how that could cause our benchmarks to go lower, maybe hedging positions, maybe using the options market as a way to collect premium or something to sort of limit your downside or at least protect you from potential downside. I don't see a problem with that sort of general thinking in this environment, given the nature of the one that we've had so far. A couple of the charts here as we continue our market recap. Breadth, of course, is very important to me. The advanced decline lines overall are holding up quite well. As a matter of fact, the large cap advanced decline line, close to making a new 52-week high as of last week. So overall, pretty good. This is a chart I wanted to highlight for you, which is the percent of stocks above their moving averages. This is using the S&P 500 as a universe. You can see that as of today's close, about 67% or 2 out of every 3 S&P 500 members remain above their 50-day moving average. That's a pretty good number, and the fact that that's improved from around 45 to over 65 just in the month of July tells you that a number of stocks are starting to pop higher. Things that had pulled back or had failed to participate are now starting to engage to the upside. So you're seeing more and more stocks going higher. 75%, 3 out of every 4 S&P members remain above their 200-day moving average. So I would say the long-term breadth has never been brought into question, but certainly we're continuing to see signs of strength. This is maybe the most bullish chart I could show, which is just the number of stocks making new 52-week highs. Today, on Monday's close, about 14%, 70 names out of 500, 14% of the S&P 500 members made a new 52-week high today. And that number has been increasing over the last week or so. So as we have sort of broken above previous swing highs, closed above 5,500, now 5,600. You're seeing a bunch of stocks more and more actually make new 52-week highs, and that's important. In a healthy bull market environment, you want an expansion in new highs as more and more stocks are actually leading the way and propelling the major benchmarks higher. I think you're actually starting to see that. So get concerned when there's less green on this chart, not more green, which is what I would say I'm observing right about now. I do have to highlight one potentially bearish signal. We talked not last month, but I think we talked in the month of May about the Hindenburg Omen, which is a famous, sort of market crash indicator, for lack of a better term. Looks at a series of indications, and basically this was created by a market strategist named Jim Mieka decades ago, looking at major market tops, trying to find some consistent patterns. And he found that this combination of factors tended to be present at major market tops. Number one, the market has to be going higher. That's what tells us we're nearing potentially a top. Number two, you need to have an expansion in new highs and new lows, which would represent indecision. So a bunch of things going up, a bunch of things also going down. And then breadth needs to turn negative, measured by the McClellan oscillator going below zero. When all three of those things happen, it's called the Hindenburg Omen signal. We actually did get one last week. This was on last Wednesday. Now, the problem is it was over a month since the previous signal. So earlier in 2024, we did get a signal third week in May. We did get a signal early in February, but a part of his approach was that you had to have multiple signals within 1 month, within about 20 trading days. We missed that mark with the signal in late May. So I would say that this signal that we got last week reinitiates the indicator. You would need a second signal within the next 3 to 4 weeks to confirm that Hindenburg Omen. If you look in these shaded areas, you can see that a Hindenburg Omen sell signal is usually one of those things you don't want to ignore. It's not a guarantee, right? So you got one in mid-2019. It ended up being not much of a drawdown at all. But the COVID peak in 2020, the latest major market peak in 2021 into 2022, both had a Hindenburg Omen, a validated multiple signals within 1 month. So the clock is ticking yet again to see if we get those multiple signals in a confirmed Hindenburg Omen. Let's talk a bit about small caps, because small caps continue to thrive here. Last week, I was actually watching Tom Bowley's show. He did a great job of talking about the strength in small caps. Sorry, I'm looking for that one chart. I couldn't talk and search for a chart at the same time, though. But I do want to point out that small caps overall continue to show strength, up another 1.9%. This is using the Russell 2000 ETF, ticker IWM. And what I wanted to point out is that over the last 3 days, so from last Wednesday to where we're at now today, at the end of Monday's session, we had what's called a coil pattern on small caps. This is after breaking above a very prominent resistance level around 195 on the IWM. We broke above there, had a bit of a false start, and then broke even higher to make a new swing high about around 210. And then over the last 3 months, we've had a coil pattern, or a symmetrical triangle pattern of lower highs and higher lows. And what you look for in that pattern is usually about 3/4 of the way, 2/3 of the way through that pattern. You normally have a break out to the upside, which indicates further upside momentum to come, most likely, or we break through the lower end, which suggests most likely further weakness. The latter, strength, is what we learned. And Thursday, Friday, now today, continuing to follow through, and I propel that. I think small caps are in a very constructive pattern. Look at the weekly chart of the IWM to see how important this is, right? If you look back, there's the peak in 22, early 23, mid 23. We broke above there, basically retested it middle of this year in April, and now all of a sudden breaking above above 210 really suggests at least a return to the previous high, if not further, right? But this is a chart in a position of strength. The weekly MACD is now given a buy signal above the zero level. Overall, small caps are finally in a pretty decent position here. Let's look briefly at the chart of Bitcoin because it has started to follow through to the upside. I just want to check in on where that's played out. Here's the chart of Bitcoin. Interesting one because we actually broke briefly below the 200-day moving average. When we break through the 38.2% retracement, that would tell me most likely we're going down to 52,000. We didn't quite get there. We got to around 53,500 earlier in July, but now all of a sudden we're rotating back to the upside. The momentum overall is quite strong. We've come out of oversold regions, now an RSI above 50, very close to above 60. Love to see Bitcoin get above that 50-day moving average with an RSI pushing above 60, which is much more consistent with bullish trend characteristics and bullish momentum. And if that's the case, all about a higher low. And if we can secure a new higher low above the 200, that can indicate a real rotation and potentially a retest of previous all-time highs in the mid 70,000 range. Let's finish off here looking at some stocks and sectors. Just want to point out our top two performing sectors today: energy and financials. Let's start with the energy sector. You can see the XLE bouncing off support at the 200-day moving average here in mid-June. Again, here in early July. Now we're at the upper end of that range. We're back above the 50-day moving average here on the daily chart. And I'd love to see if we could get a confirmed break above 92, which would take us above the swing high from earlier in June. Overall, I think this is a nice rotation to the upside. I like the retest of support, if not a clear higher low here in July. And now it's if we can make a new higher high and propel ourselves above the early July highs. Momentum that continues to improve. That would validate that breakout as well. I just want to highlight a couple names that are of interest. I think Apache is sort of a good example of the energy stocks that have been struggling for quite some time. Not all energy looks like this. The chart of the XLE, of course, looks a lot better. But Apache was one of those that has been struggling for quite some time. And you can notice that by just the fact that it's made lower highs and lower lows. You could take a trend line using the major peaks here. So if I take that high there, maybe connect it to some of these subsequent highs, right? I connect that peak in September to that peak in October of last year. That lines up pretty well with the April peak. We're right there, right? So really close to making a valid break above trendline resistance. You have to wait for follow through and wait for a valid breakout, but overall pretty interesting. And that's after making a clear higher low last week. And that's as the momentum is improving. The RSI has pushed above 60 for the first time in a couple months. So I like that potential rotation. Apache was up about 5% today. Another one I'd show you is Diamondback Energy, ticker FANG. This is one making a new 52-week closing high today. You can see this retest of the April peak. What I would love to see now after the stock is up over 3% today is if we can get a valid break above that resistance level, right? We're sort of trading to resistance. Can we trade through resistance? Sort of show additional buyers are willing to push Diamondback to a new 52-week high even further. Watch the yield on some of these energy stocks. Decent yields. You have capital appreciation, meaning the price is going up, and decent income because the dividend is fairly significant. You get the best of both worlds. Strong performance, strong income in the form of a dividend, and that can be a really nice place to be at a time when you're getting rotation into these areas of the market. We'll finish off just talking about the financial sector, the XLF making a new 52-week high today. Nice breakout. You probably would label this an ascending triangle pattern, which is where you have consistent resistance, you have an increasing support. That makes an ascending, upward sloping triangle. Today's break basically suggests a move to much further highs here. Let's look at two tickers, two ETFs. The bank ETF, the KBE, sort of the money center banks, bulge bracket firms. You can see a break above 48 on an unadjusted basis here was pretty meaningful. That happened last Thursday, and then Friday, now Monday, continuing to follow through. So I love when you have a breakout above resistance and then additional upside. That's called follow through, which is a key metric to look for, and I think you've seen it here. An example of a chart that fits into that ETF would be something like a Goldman Sachs. Look at this nice pullback to 50-day moving averages. Happened a number of times. Happened in mid-June. Great buying opportunity, it turns out, because now we're up another 50 points just from that point about 4 weeks ago. Also look at the KRE. If you think the banks chart looks good, what about regional banks? Bouncing off of support here around 46 for the KRE, now bouncing above resistance around 50 to 52. We're now breaking potentially above that high from earlier in 2024, end of 2023. Two charts I'll show you in this one. SG is not the chart I'm looking for. What was I? Oh no, sorry, KeyBank. I was going to say, I meant KeyBank. There we go. So what's interesting about the charts like Key, and some of these regional banks have a really good dividend component. The yield is pretty impressive here, but what's really impressive is if we would break above the highs that we've established in the first half of 2024. Key first reached around 1550 here in late March. You can see a number of tests of that level, including very importantly here in mid-May, where I think the fact that we did not eclipse those March highs was meaningful. It was an important message. We pulled back to an ascending 200-day moving average. We found support. We're now breaking higher. We are overbought as we are testing that level. But look at how the momentum is improving. So in a distribution phase, the RSI usually stalls out around 60. In an accumulation phase, the RSI often becomes higher than that. And what you look for then is a higher low and propelling ourselves above that previous resistance. So I think a chart like Key above 16 is a very impressive breakout that has followed through on stronger momentum. This is the type of chart that I think we're seeing now in the financial sector. One final chart to leave with you, and that's just looking at something like Amazon, just looking into the last year as we see breakouts in financials and energy. Just a couple of the names that I showed you. Amazon and other growth names are actually pulling back over the last couple days. So since the last Wednesday, Thursday, Friday, a lot of those bank stocks rallying, a lot of the energy stocks rallying. Amazon has actually sold off from 200 down to around 190 or so. Now again, this isn't that bad of a day. It's down about 1% today, but in the short term on that tactical time frame, we're certainly seeing value up, growth down, and I think that is a theme. July into August might be a very important one to watch. We're so used to stocks like Amazon working so well. What if they don't? I would be watching 190 here. That's the breakout level in April and May. It's also the 50-day moving average around there. So I think if that can hold, this is still a very good chart. But if that starts to break, then you have to question the further leadership from growth names like Amazon. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the final bar. I'm Dave Keller here at Stockcharts.com. Be well, stay safe, have a good night.